You hear a lot about blockchain technology, right? Imagine a special kind of computer system that's like a super secure digital notebook. Instead of one person keeping it, lots of people all over the world have a copy. When someone adds something to the notebook, like a digital drawing or a list of transactions, it's locked in and can't be changed. This makes sure that nobody can cheat or tamper with the information. But before we dive into the topic, make sure to subscribe the channel for more motivating content and share your thoughts in the comments below. Unlike a traditional ledger, blockchain is not kept in one place. It's distributed across many computers, or nodes, worldwide. This decentralization makes it extremely secure. Transactions are grouped together into blocks. Each block has a limited capacity for transactions. Blockchain uses complex cryptography to secure transactions. Once a transaction is added to the blockchain, it's extremely challenging to alter or delete. A new block is created, linking to the previous one. This creates a chain of blocks, hence the name blockchain. All participants in a blockchain network can see the same data. This transparency fosters trust in the system. Once recorded, it's nearly impossible to change, enhancing the integrity of records. Blockchains use consensus algorithms, such as proof of work or proof of stake, to validate and add transactions to the ledger. The most famous use of blockchain is for cryptocurrencies like Bitcoin and Ethereum, which rely on blockchain to record and verify transactions. Blockchain enables the creation of self-executing contracts called smart contracts. They automatically execute when predefined conditions are met, without the need for intermediaries. Blockchain can be used to trace the origin and journey of products, ensuring transparency and authenticity. Blockchain can be useful for enhanced security, transparency, reduced fraud, cost savings through automation, and trust in peer-to-peer transactions. But also it can cause scalability issues, energy consumption, and regulatory concerns. Blockchain technology has the potential to disrupt various industries, including finance, healthcare, supply chain, and more. In summary, blockchain technology is a revolutionary system for securely recording and verifying transactions across a network of computers. Its decentralized and tamper-resistant nature makes it a powerful tool with numerous applications beyond cryptocurrencies. Are cryptocurrencies the same with blockchain technology? Maybe yes, maybe no. Let me explain. Think of cryptocurrencies as special digital coins or tokens. They are like the money you use in video games, but you can use them in the real world too. These digital coins are super secure because they live on that special computer system we talked about earlier, the blockchain. They aren't controlled by any one person or government, which makes them different from regular money. People use cryptocurrencies to buy things online or even as a fun way to save and invest their digital money. Investing in cryptocurrencies is a bit like collecting digital treasure. Instead of physical coins or bills, you get special digital coins on your computer. People do this because they believe these digital coins will become even more valuable in the future. It's a bit like buying a cool video game item and hoping its price goes up so you can sell it later. Investing in cryptocurrencies can be appealing for beginners, but it's important to approach it with caution due to its inherent volatility and complexity. Start by learning about cryptocurrencies and blockchain technology. Understand how cryptocurrencies work, their use cases, and the underlying technology. Familiarize yourself with key terms like wallets, exchanges, and private keys. Explore the potential risks associated with cryptocurrencies, such as price volatility and security concerns, to make informed investment decisions and navigate the crypto space effectively. Cryptocurrencies are known for their price volatility. Determine how much risk you are willing to tolerate and only invest what you can afford to lose. Cryptocurrency investments should be part of a diversified portfolio. You may want to consider staying updated on cryptocurrency news and market trends to make well-informed decisions and be prepared for the dynamic nature of the crypto market. Select a reputable cryptocurrency exchange to buy, sell, and trade cryptocurrencies. Ensure the exchange complies with regulatory requirements and has a track record of security. Make sure the exchange offers a user-friendly interface, strong customer support, and a variety of cryptocurrencies to choose from. Consider using a cryptocurrency wallet for added security. Hardware wallets are highly recommended for storing significant amounts of cryptocurrency. They provide offline storage, making it difficult for hackers to access your assets. Moreover, remember to keep your wallet's private keys and recovery phrases secure and never share them with anyone. For beginners, it's wise to start with a small amount of capital to gain experience. You can gradually increase your investment as you become more comfortable with the cryptocurrency market. Also consider setting clear investment goals and a strategy, whether it's long-term holding, trading, or diversifying across different cryptocurrencies, to guide your investment journey in the crypto space. Avoid putting all your funds into a single cryptocurrency. Diversification is a smart strategy for managing risk when investing in cryptocurrencies. Instead of putting all your funds into just one cryptocurrency, it's wise to spread your investments across multiple digital assets. Start by focusing on well-established cryptocurrencies like Bitcoin and Ethereum. These are often considered safer bets due to their strong track record and widespread adoption. As you gain experience and confidence in the market, you can consider smaller, riskier coins that may have higher growth potential but also carry more significant risks. Before you jump into the world of cryptocurrencies, take the time to understand the project behind each coin you're interested in. Dive deep into their white papers, which are like instruction manuals explaining what the cryptocurrency does and how it works. Investigate the team behind the project. Experienced and reputable developers are a good sign. Look into the coin's use case or what problem it aims to solve. Is it something that makes sense to you? Community support is crucial. Is there an active and engaged community of users and developers around the coin? This can indicate the coin has a real, sustainable following. Cryptocurrency investments, like any other, carry risks. Avoid investing based solely on hype or rumors. Instead, make informed decisions grounded in your research and understanding of the project. Enabling two-factor authentication is a crucial step to enhance the security of your cryptocurrency exchange and wallet accounts. Cryptocurrency accounts, just like any other online accounts, can be targeted by cyber criminals. Two-factor authentication acts as an extra layer of protection. In addition to your regular password, you'll need to provide a second form of verification. This could be a code generated by a mobile app or a code sent to your mobile phone via SMS. It adds a significant barrier for hackers and provides peace of mind knowing that your digital assets are more secure. Use unique, strong passwords, enable biometrics if available, and regularly update your software and firmware. Staying informed about cryptocurrency news, market trends, and regulatory changes is crucial for cryptocurrency investors. Cryptocurrency news provides insights into the current market sentiment, helping you gauge whether investors are optimistic or pessimistic about the market. Monitoring price movements is also essential because cryptocurrency prices can be highly volatile. Being aware of market trends helps you identify potential opportunities to buy or sell digital assets at the right time. Be aware of tax regulations in your country regarding cryptocurrency investments. Keep records of your transactions and consult with a tax professional if necessary. Cryptocurrency markets can be highly volatile, Avoid making impulsive decisions based on short-term price fluctuations. Take a long-term view of your investments. Defining your investment goals and establishing an exit strategy are crucial steps in managing your investments effectively. Investment goals are what you want to achieve with your investments, whether it's saving for retirement, buying a house, or growing your wealth. These goals guide your investment decisions. An exit strategy is a plan that outlines when you will sell or hold your investments. It includes conditions for taking profits and cutting losses. Having a clear strategy helps you avoid making impulsive decisions based on emotions. It's important to stick to your plan and periodically review your investments to ensure they still align with your goals and risk tolerance. If needed, seek advice from a financial advisor to create a suitable strategy tailored to your situation. Remember that the cryptocurrency market is speculative and risky. Only invest money you can afford to lose and never invest your entire savings. Cryptocurrency investments should be approached with caution and thorough research, especially as a beginner. In this video, we've explored the exciting world of blockchain technology and cryptocurrency investment. Remember, cryptocurrencies offer unique opportunities for growth, but they also come with risks. As you embark on your cryptocurrency investment journey, set clear goals, assess your risk tolerance, and establish an exit plan. Seek knowledge, diversify your portfolio, and consider professional advice if needed. Cryptocurrency investment can be a rewarding path towards financial success, but it's not a guaranteed one. So, invest wisely, stay patient, and Poetics of Success is your path to success.